Hello, this is Danny with Financial Planner. I wanted to do a summary of the tax bill that was recently passed a couple of weeks ago and recap all of the major points that were put into place, given that we reviewed it together when it was just the House version. So now that it's the final version, wanted to um, cover what the final provisions were. So share my screen here and I'll talk through that. All right, so this is the bill was signed into law on the 4th of July. It permanently extended a lot of the provisions that were in the previous bill that was passed in 2016. So it has some new stuff. So we'll go through all of that here. So um, so firstly, tax brackets were extended, and they kept them the same. The first two tax brackets, though, will receive an extra inflation adjustment, meaning they're stepping up or expanding just a little bit. So an additional $400 in the 12% bracket, and $1,800 in the 12% bracket. This should be 10 and 12% there. But in essence, that expands everything else above that. So the 22% bracket's going to be expanded because the previous two brackets were expanded by, say, $2,200 in total. So that's a good thing for taxpayers there. The standard deduction, keeping with the theme that we had before with the flat 15,000 or 30,000, it's been adjusted for inflation going forward. So 15,750 for single taxpayers, 31,500 for joint taxpayers there. So that's the standard deduction. We'll get into some of the itemized deduction changes next. So if you itemize, previously there was a $10,000 cap on your state and local taxes. So that included income taxes coming out of your paycheck, property taxes, and the like. It's been expanded to 40,000 now. So pretty significant adjustment. This change is the only change in the bill that's, I guess, kind of retroactive to take place for 2025. Everything else is effective 2026. So that's that. Now, if your income is high enough on a married taxpayer, 500,000 to 600,000, that's single folks as well. 500 to 600,000, that is phased down. And on the next screen, I'll show you what that kind of looks like visually. So you can see that here, 40,000 until your income level reaches that $500,000 threshold, and then it's phased down. So if you're at 550,000, you're getting, somewhere around 25,000, say, of state and local tax deductions there. So that's how that's going to work out there. One other big change that we did not talk about in the previous versions that kind of blindsided a lot of folks is this 0.5% floor of your AGI for charitable deductions. So similar to medical deductions where you have to exceed a certain amount of your income before you can deduct anything, they've implemented that for charitable deductions. So if your AGI is $100,000, you can see here, you have you have to exceed $500 in deduction so this is talking about giving stock. So don't look at the math down there. 0.5% of your AGI of 100,000, that would be $500. And so say you gave $1,500, you're only going to get to deduct $1,000 in that case. So this is another opportunity to consider lumping charitable deductions or using a donor advised fund. So that would be give 2 years of donations this year, skip a year next year, and 2 years of donations in the following year, and so forth. So that's that. Um, so uh, given the different types of things you could donate, stock versus cash, it gets a little bit more nuanced there, but we can dig into that if those details apply to you. Other itemized deductions here. Mortgage interest, they didn't change anything on that. So the maximum mortgage balance that you can deduct all your interest on is still 750,000. It's not indexed for inflation, so that's going to start to bite some folks, if you buy down the line. One other change, though, is they're allowing the mortgage insurance premiums to be deductible going forward there. Another change is educator expenses. It used to be a deduction higher on your tax return for $300 or $600. Now it's a part of your itemized deductions, meaning you need to itemize to claim it, but there's no longer that $300 or $600 limit. Now, in the case of taxpayers with high income, if you're in the 37% tax bracket, they're limiting your itemized deduction grand total to 35% of your income. So, in essence, you can't get any more benefit for itemized deductions above the 35% tax bracket. If you're in the 37% bracket, you're going to lose some of those itemized deductions there. So that's that. Child tax credit, they've increased it a little bit, $200, and they've indexed it to inflation, which is something that it hasn't been adjusted for inflation in the past. So that's the big news there. The Section 199A deduction, that is the 20% of qualified business income deduction meant to normalize individual taxpayers, business owners' tax rates versus corporate tax rates. So uh, the House version had a 23% deduction. They kept it at 20%, and there were some other tweaks there behind the scenes. So that largely stayed the same there. Now, one thing that did change is there's a minimum deduction. So you will, at the very least, get a $400 deduction for active businesses there. So that works out. If you only have $1,000 of business income, works out to a 40% deduction. So that's that. If you got something small on the side, I guess. AMT adjustments. So they've made the changes they've made make it more likely that AMT is going to become in the picture again. So they changed the phase out thresholds. The biggest risk of getting AMT exposure now is if your income's between $300,000 and $500,000. In the past, your income had to be much higher to worry about AMT there, the alternative minimum tax. So and then if your income is higher for a joint filer, 1 million to 1.25 million, it's very punitive. There's a 42% marginal AMT rate there. So something to think about there if you have incentive stock options or other large AMT adjustment items. That's probably the only one that's going to apply. But if that applies to you, then maybe we need to put our heads together and think about how to plan for that AMT adjustment there. These are some other provisions that they extended in the bill. No big news items on this front here. I guess the big one is the gift and estate tax threshold was increased to 15 million, and it's going to continue to be inflation adjusted. There was a concern that that was going to drop back potentially all the way down to $1 million. So that's been extended there. So that's that new stuff. None of this doesn't apply to any of my any of my clients. But there's a new additional deduction if you're age 65 or higher. It's below the line deduction, so I'll make some distinctions around that language here in a moment. But an additional deduction for each individual taxpayer that's over age 65. There's an income threshold or phase out as well on that one. Charitable deduction for non-itemized itemizers. So you're still doing the standard deduction. In the past, they had this and then it was phased out a few years ago. But if you give cash to charity, you're allowed to deduct up to $2,000 if you're a joint filer, in addition to your standard deduction. So that's nice if you gave a small cash donation, but your overall deductions don't exceed that standard deduction threshold there. All right. Um, the no tax on tips, and then I'll get to the no tax on overtime component in the next one there. So this, once again, doesn't really apply, but I think it's interesting how they're implementing it. It's no income tax. You still have to pay payroll tax on this income, both overtime and on tip income. You have to be ordinarily and customarily receiving tips in your income. But notably, musicians, artists, and entertainers are excluded from claiming this deduction. So kind of stinks for them. So that's that. No tax on overtime. The way they're doing this is like it was previously modeled, but essentially, if you make $20 an hour and $30 an hour for overtime, the overtime $20 an hour is still taxed in full. The extra $10 an hour of overtime increased pay, that is eligible for a deduction here. The all of it is still subject to the payroll tax, Social Security, and Medicare there. So when I'm talking about below the line deductions here, here's another one, the auto loan interest deduction. This is the $10,000 for a car that is assembled in the US. So you get to make that deduction there, although there's a fairly low income phase out. Now back to this below the line deduction, I want to differentiate between above the line and below the line deductions, and then an additional below the line deduction, which is new. So above the line deductions are things that reduce your income before you get to adjusted gross income. And adjusted gross income impacts how Social Security is taxed. The amount that you can claim for those medical expenses, if or the charitable deductions, when we're talking about 0.5% of AGI. So that includes 401k contributions, IRA contributions, HSAs, self-employed health insurance, all of that kind of stuff, capital losses and whatnot, which lower your income overall. Now, below your adjusted gross income is the normal below the line deductions, which would be your standard deduction or your itemized deductions. We're used to that. And then this qualified business income deduction, that's another item that we're used to being below the line. In addition to that, now we're going to have all these extra ones, the amount for seniors, charitable contributions, the tips, the overtime, and the car loan interest. So I can blow this up real quick so you can see what those look like there. That's the below the line deductions that we're used to seeing up top, and then the new stuff here below the line, in addition to the old below the line stuff there. So, um, so So one thing I wanted to point out here, don't have a slide on it, but there were several federal government employee provisions that were stripped from the bill. The House version had some limitations and adjustments to federal benefits. All of those were yanked from the final version of the bill. So no concern about losing the FERS supplemental annuity. If you know, you know. So that's something that was removed from the final bill. The at-will hire surcharge provision was removed for current employees. New employees may be subject to those extra contributions for their FERS benefits there. And then they kept the high three salary formula for your annuity payout versus the proposed high five salary. So all of those provisions remained or were pulled. Everything stayed as it was previously. So moving on to 529 plan expenses. So they've expanded the amount that you're allowed to withdraw from 529 plans for expenses prior to college. So previously it was $10,000 starting in 2026. It's boosted to 20,000 there. So these would be able to cover K through 12 expenses, including and homeschool expenses, including tutoring outside the home, standardized testing, fees for other stuff, and then there's some provisions for students with disabilities. So a significant expansion on that piece there. And then credentialing expenses, if you're like me with the CFP or the CPA, you can use a 529 plan to cover those expenses there. I don't know that the juice is worth the squeeze if it's a $100 credential, but to open a 529 plan, get a 5% state tax deduction for your contribution and pull it back out, probably not worthwhile, right? Um, One interesting provision, which I think we need to dig into more as more details come out, there is 100% federal tax credit for contributions to scholarship granting organizations starting in 2027. So this is in essence giving money to a charity that will grant scholarships to students to go to, private school or something similar to that. So in essence, you can either pay $1,700 to the federal government for taxes or $1,700 to one of these organizations, and your tax bill, will remain the same. So some that's pretty interesting. Some states like Arizona already offer this. So if your state has something like that, you need to net the benefits there. You can't double dip with state tax credits and federal tax credits. So but something pretty interesting if you're inclined to support that sort of organization. All right. Qualified opportunity funds, these are complicated ways to defer tax on a sale. Generally speaking, I think they're too complicated and too many uh, pitfalls to consider. So just going to skip over those. Qualified small business stock, this could be huge for someone that it applies to. So previously, qualified small business stock, you were allowed to exclude 100% of the gain if you held it for over 5 years. Now they're tiering that. So if you hold it over 3 years, you get to deduct or exclude 50% of your gain. Over 4 years, you get to exclude 75% of the gain, and over 5 years, it's still 100% of the gain. So pretty significant if your holding period is less than 5 years, you get to potentially exclude some gains still. And then they've also expanded the gain exclusion to $15 million. It was previously 10 million. So this is not retroactive. It's effective July 4th, 2025. Something to consider if you're able to take advantage of this. All right. Trump accounts. I was really poo-pooing these before, but they've made some significant changes on implementation and treatment of these, so I think they're now worth consideration. So, in essence, this is an IRA for your kids that they didn't have to earn income to contribute for. So, in that respect, pretty appealing opportunity here potentially. So. $5,000 a year can go into the account directly, meaning from a parent or the child itself, right? And then if the government contributes to that, that's on top of that $5,000 limit. What I've highlighted here is employers can contribute to their own employees' accounts if they're under age 18, or to an employee's child's account up to $2,500 a year. That counts against the $5,000 a year of direct contribution, though. So something to keep that in mind in that front. So no distributions are allowed prior to age 18. The investment expenses have to be low, which is something that we want anyways for our investment accounts. These contributions do not count against earned income for IRA contributions. So say you make or your child makes $6,000 in earned income this year working, right? You can contribute 6,000 to their Roth IRA and 5,000 to their Trump account. So something that's you can double dip on and pretty cool opportunity there. So after turning age 18, it's treated like a regular, more or less like an IRA, right? Early withdrawal penalties apply before age 59 and a half. Um, the contributions that were made that were non-deductible are treated as after-tax contributions. And growth on that is treated as pre-tax. So it's kind of like an after-tax IRA. And the RMDs and 10-year rules probably apply. There's not been guidance on that, right? Um, the big one down here is they're not aggregated with other IRAs if you're doing a distribution or a Roth conversion of your other IRA money. So that's a planning opportunity to consider there. The unknowns here are, can you consolidate with a regular IRA when you're 25? We don't know. How do you get the $1,000 credit if it's a new child? The government is offering a seed contribution to that. Um, Now, how do you get that, right? And then, can a business owner make an employer contribution to their own account? So, a couple of questions that will be hashed out either from IRS or Treasury guidance or further legislation, probably. So, um, this is a comparison between the Trump account versus regular IRAs and taxable custodial accounts and 529 accounts. So, if you want to compare those there, just pause the video and take a look at that. Here's kind of another summary of that, and it's kind of interesting to see the rules before turning age 18 and the rules thereafter. So all in all, I think it's pretty appealing. It will to be determined how or where you can open these accounts, though. So, all right. We talked about the clean energy credit rollbacks. These are largely the same as what we had talked about prior. So clean vehicles is by September. Energy efficient home stuff is by year end. Uh, and so if you're planning on doing any of that stuff, it's time to get moving on it, in essence. So. Um, so this last one here is all of the phase out ranges for each of the different deductions or provisions there. So you can see things are a little bit more complicated now, given all of these. So these blue lines are all of the phase out ranges at different income levels. So doing tax planning is going to be a little bit more complicated from now on. It always seems to get more complicated, but happy to help do a tax projection and dig into those details with you there. So, any questions, please reach out. More than happy to dig into some of these provisions more deeply for your specific circumstances. But otherwise, please reach out with any questions. You guys know how to reach me. And thanks for your time.